Hey everyone, and welcome to another episode on Wealth Strategy Secrets. And today, welcome to the best of 2023 episode of our podcast. It's been such an honor to have had so many amazing guests on the show, and I hope you've been getting some amazing insights as I have, increasing your learning, increasing your mindset, really transforming how you think about money and what it really means to you. So today, we're revisiting some of the most insightful moments of the past year, featuring wisdom from experts who are redefining wealth and success. So let's dive into a journey of mind mastery, wealth strategy, and innovative investment insights.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
First up, we have Trevor McGregor discussing mastering your mind. Trevor's approach to mental strength and clarity is not just transformative, it's essential for anyone looking to excel in their personal and professional life. Here's Trevor on why mindset is the foundation of success.
So what do you think is really at the core of holding people back, Trevor?
So the very first thing I would say to anyone before is be very careful that you're not labeling something you've done or seen somebody else do as failure, because as entrepreneurs, there is no failure. There's only feedback. We literally are all people who rationalize. And if you break that word into two, we often tell ourselves rational lies. We lie to ourselves that we're too young, or we're too old, or we're not educated enough, or we're educated too much, or I've got it good in my W-2. I should be happy with what I've gotten. And I'm telling you, this is the work of our saboteur brain instead of our wise sage, because the saboteur wants to hold you back and, throws all of these limiting beliefs at you because it doesn't want you to get ahead. So if limiting beliefs are, the work of the saboteur, we also have to remember that there's a polar opposite to everything on the planet. It's called the law of polarity. You can't have the saboteur limiting belief brain without the polar opposite of that being available for all of us as well, which is what we call the wise sage. And it's the wisdom. It's not just you thinking in your head, but also in your heart and in your gut about what it is that you're trying to do and why do you want it. When the why is big enough, the how starts to present itself. So if you really wanted to be successful, whatever asset class you're in, you've got to go out there and believe that somebody out there has already achieved what it is that you failed at. But again, you haven't failed, you just got some feedback. So that's where coaching or mentoring or masterminds or meetups or conferences are literally the thing that I would recommend to anybody who wants to go further faster. Because again, this is really all about turning what we call, Dave, decades into days. What is your big, fat, compelling reason why you want it? And it's not the money we want, it's what we can do with the money, right? Whether we can use it to live a better quality life or give some of it away or do some charity work, travel the world. So once you stop telling yourself the rational lies, and once you access the powerful sage, and once you go back to the power is in the why, and then not just forget about it, but make sure that they're revisiting that why on a daily basis. Media's job is to distract you. Media's job is sensationalism. Media's job is to, get you to not pay attention. And, it brings up a great quote from Jim Rohn, who was Tony Robbins' coach. I'm sure you're familiar with Jim, where he said that it's not the winds that blow on you that will determine where you end up. It's the set of the sail. And I love that quote. It's one of my favorite quotes. In fact, it's the header on my Facebook page. But he said, it's not the winds of change that blow on you that will determine where you end up. It's the set of the sail. And who's responsible for setting your sail? Well, you are. Got a lot of wind blowing from CNN, constant negative news, or anytime you turn on anything. Tony Robbins calls the television the electronic income reducer, because it's absolutely true that if you get caught up in what they're saying, you're in trouble. Well, I'll tell you this, for high performers, it's not those winds that are blowing that will determine where they end up. It's the set of their sail. If you guys want to change your state, you got to change your physiology, That means you got to get up and move. You got to hydrate. You got to take care of the body. You got to take care of the mind. You got to focus on what you want, not what you don't want. And you have to become what I call your own language police. If you catch yourself saying things like, I really should do this, or I ought to do that, or tomorrow I'll try this. Should, ought to, and try are weak forms of commitment in my world, where you got to stop that nonsense and you got to start saying, you know what? I've got this. I'm doing it today. I will. I own this. I'm going to reach out for help from my, colleagues. And again, your word is your wand. So the more you start speaking in empowering language, the more you start thinking about what you want, and the more you move the body, the more you move the mind. It's definitely something that you're either going to go, well, these are interesting concepts, Dave and Trevor, thank you very much. Or you're going to do what I call taking a personal inventory. Where are you showing up in your state most of the time on a scale of 1 to 10? Where's your story most of the time on a scale of 1 to 10? What level of standards are you committing to play at? Traditionally on a scale of 1 to 10, because those three things precede, David, number 4, which is your strategy. You never want to get to number 4 without first saying, where's my focus? What language am I using? Where's my body? Where's my spirit, right? Number 2, where's my story and my identity? Am I a victim or a victor? And am I really singing from the song sheet of being a true entrepreneur like Elon or Tony or Oprah or, Steve Jobs or Richard Branson, right? You can do some character trait integration there. And then ultimately it's your standards, because those three things are ultimately what's important for you to then choose a strategy and execute on it. Because a strategy is really simple. It's, again, like you said, finding somebody out there that's already done what it is you're trying to do, whether that comes from a coach, a book, right? An entrepreneur, a company, an e-com course, whatever. I'm telling you, there's very little that hasn't been achieved before. So you're really looking to think of a strategy as having a roadmap, a recipe, a blueprint, or in today's world, a GPS that takes you from where you are to where you want to be. And there's a 7-step process that I teach. And again, it comes partially from Tony and partially from me, where you got to know, when you're talking about your strategy, you got to know step 1, which is, what is your outcome? That is, what are you really, really trying to achieve, right? You got to know your outcome. You got to know the end game. Number 2 is, why do you want that outcome? What is your why? Again, we're going back to that when times get tough or you get tired or you hit the wall, the why is going to keep you moving forward. So if I know what do I want and why do I want it, step 3 is, what are all of the things that can help me move it forward? We call that the map, or the massive action plan that you're going to jot down on paper to get ready to go make it happen. So if I know what do I want, why do I want it, really what are the things that can help me get there, steps 4 through 7 are really simple, because step 4 is to prioritize it. Step 5 is to timestamp it. Step 6 is to help yourself get leverage. And leverage simply means, who can help me, right? Is it Dave? Is it Trevor? Is it an accountability partner? Is it ChatGPT? Is it a travel agent, right? Oftentimes we think we're the only people that can make things happen when, we've got access to all of these other fabulous people. So that's step 6. And then I think you know what step 7 is, because that is execution along with course correction. And that's when you go out there and you take what I call intelligent and inspired action, because intelligent means smart and inspired really means because you get to, not because you have to. So if you think of real estate, right? And doesn't matter what asset class you're in, doesn't matter if you're new to real estate, or maybe you're an intermediate, or maybe you're an expert at it. When you think of where you are today and where you want to go, I'm telling you, you got to know what you want, why you want it, all the things that can help you get there. You got to prioritize what's the first, second, and third thing you're going to do. You got to timestamp it. You got to leverage it, and you got to execute on it, and then measure, am I on track or do I need to course correct?
If you could give just one piece of advice to listeners about how they could accelerate their own wealth trajectory, what would it be?
Well, I love that question, and I'm going to over deliver because I've got 2 things that I'll stack on that. And the first one is, number 1, check in with your hunger. I mean, how hungry are you for success? Really, do you want to settle for the appetizer, or do you want to settle for what's on the value menu, or are you really ready to have the full meal deal? Because I'm telling you, for the committed, there's always a way. But you got to check in with your hunger, and you got to refuel it to really remind yourself about the 5 freedoms and what's available to anyone who's defiantly committed to moving towards it. Again, that's number 1. Check in with your hunger. And number 2 is passion. I often find that with my clients and the high performers that I coach, whether they're Fortune 500 executives, real estate investors, doctors, attorneys, Olympic athletes. I mean, I've really had the pleasure to coach some amazing people. They really check in with their passion, right? And really allow themselves to become childlike, not childish, but childlike, and going after it and pursuing it and knowing that they can gamify and, play a game and really go after it and enjoy the journey. But again, where there's passion, there's purpose. And where there's passion and purpose, Dave, there is profit, because money becomes the byproduct of you checking in with your hunger, unleashing that passion, and going out there and using the 4 S's to climb the ladder of success.
Next, we explored a new definition of riches with Garret Gunderson in Redefining Riches. Garret challenges conventional wisdom and invites us to look at wealth beyond just numbers. Listen to this pivotal moment where he explains the true essence of being rich.
I want to be financially free at all times, and there's a framework for that, which is simply how I start my day every day. I start my day with some meditation, with a sauna and cold plunge when I'm home, with some stretching, and then gratitude journal and, intent for the day. And so I'm living by design on a daily basis. That's part of how I keep that financial freedom at the forefront, is those habits and rituals. When it comes to financial independence, well, then it's about these 5 levers. The first one being plug financial leaks. So I'm always looking at efficiency. Can I pay less to the IRS, to interest, to investment costs, or to insurance costs? Is there a way to do that more efficiently? Number 2, engineering the wealth. What is the amount of money that has to come in every month to cover my basic lifestyle, and reverse engineering to get there? That is, first on the foundational pieces, so no money's leaking through, like the first step. Second, the sustainability, because we're looking at mitigating risk in a long-term way, which could be everything from asset protection to education. And then the third piece is investor DNA. I want to invest in things that are aligned with my values, my competencies, my drivers, and I focus instead of diversify. Focus on creating cash flow, which is that third step, which is accelerating investment income. I look at all my assets and say, can I create cash flow? And I look at assets differently than most people. I don't look at assets as things I have no control over. I look at them as either businesses, real estate, or intellectual property. And I'm saying, which of those am I going to develop most of my accelerated wealth with? And then the fourth step is I'm always looking to scale that revenue, because if I have control over the outcome of the income with those assets, I can actually make tweaks by marketing, hiring, developing, eliminating, whatever it is, and that can grow a lot faster than a blue chip stock could ever grow. And then the fifth thing is to make it count. I treat myself as my greatest asset. I'm always investing in myself, and I'm always asking what's the highest quality of life along the way, so I'm not wanting to retire from my life. So plug financial leaks, engineer wealth, accelerate investment income, strategically grow revenue or scale revenue, and then fifth is make it count. That's the framework of wealth for me, because it creates that cash flow, and then I have choice where I could swing for the fences in everything that I do. Now, I have different pieces of that framework where I capture the savings. I like to put it in overfunded whole life cash value insurance as a savings account, because I think that's better than a savings account that's taxable, that doesn't have a death benefit with it, that isn't protected from liability, where a lot of people keep those money in, bonds, which right now interest rates have been going up, lowering those values. They don't have a death benefit, so they got to buy term insurance. I don't have to buy that. So I use this cash value as a way to capitalize when economies are chaotic. When the market's down, my cash value stays strong. I could then buy when the market's down, whether that's real estate, whether it's acquiring a business, or whether it's developing intellectual property, because people pay attention to me more in down markets with my financial advice. So my books tend to sell more during that time. My courses tend to sell more, because when people are lulled to sleep because they've had a strong market for no reason other than people aren't, they're just putting money in, or maybe it's even fabricated through hedge funds or whatever it might be, they're not paying attention. But when COVID hits, or when the market starts to decrease, and when all of a sudden the money they're putting in isn't getting them what they want, they start going, hey, what can I do? So So I'm always looking for having liquidity that I can then take an opportunity where other people don't have liquidity and actually profit from day one. I call that making money on the buy versus hoping it's going to work out 30 years from today. Look, the numbers are in. 95% of people in America are not financially independent at age 65. Scarcity is the biggest myth, right? But if we're talking about money, there's really three that I think go hand in hand and that most people buy into, because it's all this notion of set it and forget it one day, someday, which is we believe that wealth is a function of how much money we could put away, right? It takes money to make money. It doesn't take money to make money. It takes relationships and value. It takes exchange and service. It takes being resourceful. Money is a byproduct of value. Sure, you can make money on your money, but you don't have to have money to make money. Number two is the second faulty belief is high risk equals high return. Like, what drunken Wall Street idiot came up with that? Risk means chance of losing. How does increasing your chance of losing help you win? Instead, I believe in investor DNA, mitigating risk and having a team that helps you manage that risk. And the more aligned your investment is with you, because risk isn't in the investment, it's in you, the investor. So if you're making investments in things you know nothing about, that's taking risk. And then the third one is you're in it for the long haul. That's always about compound interest. After 30 years, you're finally going to have all this money. But the problem is, what happens the first 10 years? And what happens when life is interrupted, or you don't have your protection in place, or the market doesn't cooperate, or it was more fees than you thought? Like, there's just too much that people get lulled to sleep in the long haul. So people believe wealth is a function of money times rate times time. So high risk equals high return is the second one. It takes money to make money is the first one, and your long haul is the third one. My belief is it's all about velocity. It's all about cash flow. It's all about investing in yourself. It's all about increasing your skill sets so that you can serve more people, and then keep more of what you make with that efficiency. And then when you're in cash flow and you're economically independent using the frameworks I shared, you're going to be a whole lot wealthier than putting your money away for 30 years in a retirement plan that's going to underperform. You've got to get a framework that gets beyond scarcity and that's empowering versus abdicating responsibility. So the number one thing you do is take responsibility.
Our journey then led us to Michael Sonnenfeld, who shared the ultimate wealth strategy secrets of the ultra wealthy. Michael's insights into wealth accumulation and management are nothing short of groundbreaking. And here he is revealing a key strategy that has guided the ultra wealthy of over 1,300 ultra high net worth families.
You need knowledge and perspective and discipline, because 90% or more of entrepreneurs who are successful entrepreneurs, but then have a liquidity event, and all of a sudden they no longer are running a business, but now they have a pool of capital. They go from being managers and entrepreneurs to wealth preservers or investors. And for people who don't have capital or haven't built businesses, maybe being a wealth creator and a wealth preserver seem like the same thing, but they're radically different. All of the things that allow some of the most successful entrepreneurs to be successful predispose them to be mediocre investors. The single most important issue for somebody with a wealth strategy is, one, asset allocation and what it suggests about your view of the world. There's lots of studies to prove that if you can pick reasonably successful investments in each asset allocation, the asset allocation is more important than the investments themselves. In other words, if you have a certain percentage in stocks and a certain percentage in private equity and a certain percentage in real estate, getting the allocation of those big buckets correct over the long term is more important than the individual investments. Of course, as long as the individual investments are at least in the median of each of those areas. And in my case now, the strategy that I find most compelling is to think of my assets in three buckets. One is cash, and the cash is for both a rainy day, meaning if the market's downturn, can I survive on the cash I have without having to liquidate investments at exactly the wrong time. And in the case of Tiger 21's members, that number is about 12%. Tiger members as a whole have about 12%, 11 or 12 in cash. And if you spend 2% a year of your wealth, if you have sufficient wealth, that's the number. That's about 5 years of reserves that you wouldn't have to liquidate other investments in a major downturn. The second thing is what I would call my passive investments. Those might be index funds, stocks, investment in private equity funds, real estate. We're not operating it, we're just investing. And then the third part, and this is the biggest choice that an investor has to make, is active businesses. Do you have enough of an edge to own or participate directly in businesses that will provide superior returns, but also provide significant risk if you don't know what you're doing? So many people don't have that option because they don't have either that skill or that interest. And so then they have to say, what's realistic if I have stocks and bonds and cash or some variation of that? But the point that I'm making is that unless you have some demonstrable, quantifiable edge in investing in companies, you're not likely to outperform the markets. And historically, that would be sort of an 8 to 10% return in the stock markets, which will be reduced by whatever cash you have. I'll just end by saying, there's a study that shows the stock market since 1910, I believe, has had an average of a 9.6% compounded return. But individuals have only earned in the 4 to 6% range because individuals who aren't disciplined sell at the wrong time. They tend to sell at the low, and they buy at the wrong time. They tend to buy at the high. And that's why long-term ownership of index funds provides benefits that stock picking and even many managers can't match. There was a very famous investor named Swenson who was the head of the Yale endowment that really revolutionized endowment investing. And he came up with what was called the endowment model, and it turned the world upside down. It used to be 70% equity and 30% debt. And he started diversifying Yale's investments into natural resources, forests and minerals and other forms of natural resources and private equity and real estate. And we could go into any level of detail, but the bottom line is that he pretty regularly generated in the mid-teen kind of returns as opposed to the high single digits. And the cumulative impact of that is to make 5 and 10 times as much money over a period of time because of the power of compounding. So the current asset allocation for Tiger members is about 25%, 25 in real estate, about 31% in private equity. Those two add up, obviously, to 55%. And public equities are only 22%. Well, when you add those up, that's 76%. And the rest is largely defensive. It's cash at 11 or 12% and fixed income in the 7% range. Some currencies, commodities, Bitcoin might be in there, and hedge funds. But the overwhelming point is that Tiger members are relatively unique in the very high allocation to private equity and real estate. Private equity and real estate. Those are two illiquid markets where if you can find the best opportunities, whether it's through funds or directly, you can, pretty regularly achieve returns that are higher than the stock market, or at the very least diversified from the stock market. In the book I wrote, I mentioned that if you line 100 people up in any industry, not just finance, and line them up from least successful to most successful using any reasonable metric. So it doesn't just have to be profits or returns. It could be academic papers. It could be, there's lots of different ways, but use any reasonable basis. The half that are the most successful will overwhelmingly have had mentors in their life, and the half that are least successful will overwhelmingly have excuses for why they couldn't have mentors in their life. And peer-to-peer learning is a variation of that, because if you've just sold your business and you go into a group with a couple people who had sold their business 3 or 4 or 5 or 10 years ago, you're going to learn things you couldn't learn anywhere else. And but mentors in particular was the big learning. In almost every important endeavor, delaying gratification, making the investment up front, but not reaping the reward for some time, those who know how to delay gratification through discipline or personality are predisposed to be far more successful, because people who want to take the rewards out of an early career don't have the resources to reinvest them and use the power of compounding to build great success.
Richard Wilson joined us to discuss the hidden strategies of billionaires. His unique perspective sheds light on the habits and decisions of the world's most successful individuals. Here's a snippet where Richard unveils a billionaire strategy that you can also apply.
A lot of our clients are using less debt right now. Some clients are in trouble if they didn't have interest rate insurance, or they invest into deals where there's a bridge loan and a floating rate. So that's caused some pain, but also some opportunities for clients to take over assets just by bridging the capital that's needed, or gaining more equity than they should be able to gain, because otherwise the investors get wiped out. The other thing is they're looking for strategies that work regardless of the cycle. That there's so much value being appreciated that it makes it a good deal to do, whether everyone else is a bit scared right now or not. So in our short-term rental platform, what we're doing is buying properties all cash, sometimes with seller financing at about a 22% discount off the list price. And then we double their sleeping capacity so that we can get more revenue. So we're basically buying low, all cash, and then trying to sell high by doubling the sleeping capacity. I've been reading a lot of books from billionaires, and I wanted to show you the cover of one book so your audience could potentially look it up. It's called The Most Important Thing by Howard Marks. He's the founder, he's a billionaire founder of Oak Tree Capital, a multi-billion-dollar and AUM hedge fund. And the book is really great. And he talks so much about how when others see risk, like right now in the market, capital flows have slowed way down and investors are sitting on their hands. And he says, when others see risk and they stop taking action, there's actually less risk. Because others see risk and stop doing things, you can buy things at a discount. Now is the time where you should be putting money out. You should have been sitting on your hands when everyone was having a party at low interest rates for the last year and a half, 2 years before about 12, 14 months ago. That's when you should have been afraid, is when everyone else is excited. You shouldn't be afraid when others are afraid. And so he says that as things get really toxic and everyone thinks you're a complete idiot to put money in because this thing's going down, 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 that's when he gets the best deals of his life, he says. And so that's not easy to do. You have to have some courage to do that. But those two answers are kind of combined with each other, right? It's not like you just want to invest in any random deal when the market is shaky and everyone is afraid. You want to find the best of the best deals. And you want to find those deals that you got to see first exclusively at a better valuation, but also take action when other people are not taking action, and you'll be rewarded with better valuations on things.
Richard, you've accomplished so much in such a short period of time. What would be the single biggest learning you've had, if you could share with listeners, in terms of personal productivity?
It doesn't seem super fast from my perspective. There was one famous person, I can't remember who it is, maybe Michelangelo or something, and he said, if you knew how hard I worked, it wouldn't be impressive at all. So it's been 16 years. I know I still look pretty young for family office world, but I started the business when I was in my mid-20s. So it doesn't feel overnight to me at all. But when I started it, I wrote down affirmations. I was going to do $1 million a year in revenue. In our third year in business, we did $1 million a year in revenue. The thing that's helped me the most, though, has been a one-page kind of cheat sheet for my life. And I have my monthly, my quarterly, and my annual goals there. And then anytime I read a great book, like the Howard Marks book, or we bought billionaires.com recently, and we're interviewing 100 billionaires there, and I'll learn something that I know I need to implement. Then I'll put it at the bottom of that one pager. So I've got about 40 little statements there that I read every morning. I read them this morning. And then I start with reading my monthly, quarterly, annual goals, and then all these 40 little half-liner statements that remind me of a book or a mentor's advice, et cetera, or an insight I got myself. And so by reading that every morning, then I go out into my email inbox or on an interview like this, and top of mind are my top clients and my top goals and our platforms we're building and what's most important to me and our business and our family, et cetera. And by doing that, then I'm less swayed by random things that come up that are just a distraction, or what I've noticed is I'll quickly remove people from our circle that just aren't like positive energy or just not in line with where we're trying to go. And it's like, there's no time for stuff like that when you have a very clear define of where you're trying to go.
Yeah, it makes perfect sense. Totally agree with that. I think it is interesting. The more you focus on, it's kind of like Dan Sullivan's quote, right? The ears hear and the eyes see what the brain is thinking.
Right.
So it's really true.
Yeah, for sure. Couldn't agree more. So it's the more that you keep those things top of mind, it's almost in your subconscious then to like be looking for those things throughout your day, right? It's like your what's it called? The reticular activating system or something like that. I forget the technical word, but you're basically saying, hey, brain, look out for all these things and don't put up with these things. And it's just kind of your operating system for the day, every day.
If you could give just one singular piece of advice to the audience about how they could really accelerate their wealth trajectory, what would it be?
The most important one is seeing the deals first exclusively and at a better valuation. Get your position in the industry so that people just are thinking of you top of mind to show you that medical clinic deal or the short-term rental deal you have. That'd be the most powerful. The second one is that the more integrated your life is, then the faster things go and the faster people want to help you. And those that are aligned with you will want to work with you that much faster. So aligning, like, if I know it's important to be ultra healthy, then aligning things in my life to be more healthy, but also having the right people on my team, living in the right location, everything from the food you eat to the books you read, and how you spend your time and the media you consume, all of that. If it's integrated well, then you're constantly growing and learning and enjoying yourself. If there's a lot of friction, then you're just dragging all these anchors behind you and others can't even really see where you're going or if you're going to make it there. So the more integration and integrity you have across your whole life, then I think the faster things go, including with your investments, right? If you have certain goals and objectives for your family office that have never been written down and no one's even asked you what those are, and your family and advisors don't know what they are, and then someone shows you a deal and you don't know your family's values or your own goals, how are you going to evaluate whether you should do that deal or not? It's just, you might do the wrong deal and maybe you shouldn't be doing any deals until you figure that out.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.